cuanto a qué esperar para el próximo dato de PIB trimestral. Pero antes, para analizar todo esto y mucho más, damos ya la bienvenida a nuestro invitado internacional, Jay Pelosky, founder at TPW Advisory. How are you, Jay?
Hi, Javier. Nice to see you.
I would like to start by talking about markets. Jay, we are seeing quite a nice rally in the stock market, and I would like to ask you, what do you think about this and the outperformance also of big cap tech names?
Well, we've been quite constructive on risk assets, Javier, going back to the fall of last year, really arguing that we were going to find a middle way or a middle path between high inflation and deep recession. And we think we're on that path, and we think the markets are starting to realize this. And importantly, I think the recent bank failures of Silicon Valley Bank and Credit Suisse in particular are demonstrating to central banks that they cannot raise rates until inflation falls back to 2%, that the parts of the economy that really benefited from zero interest rate policy and work from home are too fragile to handle higher rates. And so I think over the last few weeks, the markets have basically come to the conclusion that the Fed is probably quite close to being finished raising rates. And so you saw that very huge rally in bonds, and that rally in bonds underpinned the rally in big cap tech, as you pointed out, which has been the leader really year to date. I think the S&P is up about 7%, and big tech, or the NASDAQ's up about 16 or 17. So it has been the leadership, which is interesting because in 2022, of course, it was the big laggard.
That's quite interesting. I want also to ask you, you said maybe the Fed is going to finish soon. And do you think this pivot or pause could be also bullish for the stock market? Because Goldman was sharing a graph during the last days where they put this last hike and then the returns over different periods, like 95, 2018, 2006. And normally it's bullish, but we have some exceptions, like 2000.
Yes, well, there typically are exceptions to every story, whether it's bullish or bearish, right? I mean, most people have been bearish throughout the last several quarters, and as we've seen, the S&P was up 7% last quarter and 7% in Q4, or even think about Europe, right, where you're located. People have been very bearish on European risk and European equities going back a year since the Russian invasion, and yet Europe has been the best performing region in the world over the past year, not just year to date, but literally over the last 52 weeks, Europe is actually up, whereas the rest of the markets, for the most part, are down over the full 52-week period. And I know you asked about kind of how the markets would take a Fed that goes on hold. That's what we expect. We think the Fed is finished raising rates. We think inflation is going to continue to decline, and therefore we think the Fed is going to be on hold for the rest of this year. We do not agree with the thesis that they're going to be rate cuts, because we don't expect the U.S. economy nor the global economy to fall into recession. And we believe we're in the early stages of a switch from the low inflation, low growth world that was pre-COVID from 2010 to 2020. We're not going back to that world. We're going into a high nominal growth world that is going to be focused on some major changes taking place almost like behind the scenes of the bank failures and those worries. And principally in the US at least, it's the return of industrial policy to deal with issues around supply chain management, climate change, and tech in particular. And that's the thing, it hasn't happened in the US since the 1950s. So the last time the U.S. had a big industrial policy was 70 years ago, and virtually no one investing today was investing then. And that's one of the things we think the markets are just starting to comprehend is the growth that's going to come from the return of industrial policy.
Thank you, Jay. I want to also ask about the reduction from the OPEC Plus, the last news, and the of the production. And do you think this is going to affect inflation, even if you see inflation going down in the next month? Do you think it could be
a question, Javier, because actually, if you look today, bonds have rallied pretty aggressively. So we've had two data points, one being the OPEC plus news over the weekend of a production cut in oil, and the other being the release of the ISM manufacturing data, which was a little weaker than expected. And it seems pretty clear that the markets, at least the fixed income market, is focused on the ISM data way more than it's focused on the inflationary impact of a significant production cut. I mean, we're constructive on commodities and have been talking over the last month or so that it was a good entry point in commodities, including energy, because with the SVB news and the bank failures, the commodity and kind of cyclical parts of the market really got hammered, and big tech really did well, as we just touched on. So it's interesting that all of a sudden, out of the blue comes this OPEC news, and you see the energy, big energy stocks, the oil stocks, up 6, 7, 8%. And that's really a catch-up because they're one of the few sectors, energy was one of the few sectors that was down in the first quarter. So there's a catch-up here that we're seeing unfold in real time.
And Jay, even if you said that you believe we are entering a growth phase, a nominal growth phase during the next years, this data from the ISM, the PMI, that shows a decline in a contraction in, for example, the employment. Do you think the labor market has to suffer or is going to maintain it so strong right now?
Well, it's interesting. Again, we're in these kind of transitions. We're finally coming out of the COVID period, let's say, and now we're exiting the high inflation period, which came about in part because of COVID and in part because of supply chains and then the Russian invasion. So we've dealt with a lot of things over the last couple of years, and I think we're gradually moving towards kind of a return to stability. And in that environment, I think it's an opportunity for markets to think about this different future that we at least see unfolding around industrial policy focused on climate. And in terms of manufacturing in the U.S., here's a quote that I read last week that I referenced in our weekly musings. There's never been a better time to build a factory in America. And that was a quote taken from one of the Volkswagen representatives, because what's happening with this industrial policy, the Infrastructure Act, Inflation Reduction Act, CHIPS Act, all in the United States, is that the EV production supply chain is relocating within North America and within the United States, and the semiconductor companies are setting up fab plants in the United States with ancillary products and platforms in Mexico. Mexico is the best performing stock market in the world year to date, and it's mainly because it's the big winner from the reshoring of activity to take advantage of this industrial policy, which is in some aspects subsidizing companies to put production in the United States and in Canada and in Mexico. And we're seeing the reignition of the North American kind of regional integration around supply chains for electric vehicles and semi-fab production. So I expect we're closer to the end of the decline in the ISM. It's already been declining for 25 months in a row Typically, the declines average about 17 months. So this is already 6 months longer than the average decline. So I think we're closer to the end than the beginning. And again, we believe people are going to be surprised over the next 6 months, 12 months, 18, 24 months at the pace of economic activity in the United States, in Europe, as well as in Asia, where China, of course, is reaccelerating.
Very interesting, Jay. Thank you for your time. Jay Pelosky, founder at TPW Advisory.
Thank you, Javier.
Y nosotros continuamos.